Ladies and gentlemen, good day and welcome to Galaxy Surfactants Ltd Q3 and 9-month FY2026 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantee of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. K. Natarajan, Managing Director from Galaxy Surfactants Ltd. Thank you, and over to you, sir.
Thank you. A very good afternoon, ladies and gentlemen. Thank you for joining our third quarter earnings call of financial year 2025-26. If the first half was about resilience, our Q3 has been a quarter where multiple headwinds converged, testing our agility, execution, and resolve. Before delving into the specifics, it is essential for us to understand the broader context and the developments over the quarter and the year-to-date period. The major factors that have shaped our performance since last two quarters can be enumerated as below. First, reformulation pressures arising from reformulation of a key ingredient by one of our key Tier 1 account in India within our performance surfactant segment due to persistently high feedstock prices. This continues to weigh on volumes and contributions since last two quarters. Second, in India, the GST rate rationalization, while a long-term positive for the fast-moving consumer goods value chain, it caused a temporary demand disruption from end of September and spilled into October month due to deferment of purchases and inventory adjustments, the after effects of which were seen into the festive period in the upstream value chain. Third, the reciprocal tariffs imposed by the US on Indian exports, as we highlighted in Q2, continue to impact the contribution of a specialty segment originating from India and affected the pace of conversion in some pipeline projects from Q3 onwards. And fourth, the dynamics of fatty alcohol pricing, which have stayed buoyant at a very high level since last year. Amidst this, it is important to highlight a significant and positive development on the tariff front. Following the recent bilateral update between India and the United States, the reciprocal tariff on Indian exports have been reduced from 50% to 18%. While we await the fine print of the announcement, Galaxy strongly welcomes this state development. As global supply chains continue to evolve, this tariff normalization restores competitiveness and creates a more level playing field for us in the US market. Lower landed costs and improved pricing flexibility will not only help us rebuild traction in the near term, but it will also strategically strengthen our long-term position in North America. We also believe this move will support the reinstatement of our existing customer pipelines, accelerate penetration in high-value specialty opportunities, and unlock new avenues for growth. While the past two quarters reflected temporary hiccups due to the tariff-led disruptions, this development is a major structural positive for us going forward. While oleochemical feedstocks saw a brief softening driven by a sharp trough in November on account of record palm oil production and stock buildup, the easing was short-lived. Market participants expected further declines and therefore stayed cautious, resulting in an average basket correction of about 8% for Q3 in our India business. Unfortunately, the unusually wide and prolonged spread between fatty alcohols and crude petroleum, as communicated earlier, also a phenomenon rare over the last 3 decades, has kept reformulation risk elevated, and this played out adversely for us in India again this quarter. Coming to the numbers in specific, for Q3, consolidated volumes were stable on year-on-year basis. The performance surfactants portfolio experienced a high single-digit decline. However, this was offset by a high single-digit volume growth within the specialty segment. The specialty segment's resilience delivered growth despite tariff-induced uncertainties, and this was primarily supported by continued momentum in our non-US markets in the rest of the world bucket. Our Q3 FY2025-26 EBITDA before exceptional items increased by 13% year-on-year to 124 crore versus 110 crore in the similar quarter last financial year. Consequently, EBITDA per metric ton improved to 20,156 per metric ton compared to 17,527 per metric ton in the previous year. This uplift was driven by strong volume growth from our non-Tier 1 customer accounts, improved contribution realization from the masstige segment in India and prestige specialty products in the rest of the world, incremental service income from our ongoing EPC project, lower logistics costs, and the successful execution of multiple cost efficiency initiatives across the group. Our YTD 9-month financial year 25-26 EBITDA before the exceptional items remained flat year-on-year at 376 crores versus 375 crore in the YTD 9 months FY25. And consequently, our YTD 9-month FY26 EBITDA per metric ton before exceptional items stood at 19,126 per metric ton versus the last year YTD 9 months number of 19,272 per metric ton. During the quarter, we also recognized exceptional items related to the new labor code to the extent of 11.9 crores towards the enhanced impact due to revised calculations of gratuity and leave encashment. These are though one-time adjustments and do not reflect underlying operating trends. They are however necessary and hence prudent provisions have been made aligned to the new statutory regime. Moving on to the regions. First, India, our domestic growth engine. The volume grew by mid-single digit year-on-year for Q3 FY26. Within this, the performance surfactant segment degrew by roughly 4% year-on-year, largely reflecting the continued reformulation in few Tier 1 accounts, whereas our specialty business delivered more than 35% volume growth year-on-year basis. The GST reset led to inventory adjustment by all our customers in October month, which created a temporary blip in the uptake, and the US tariff overhang continued to weigh on our specialty business volumes exported out of India. That said, the broadening of our franchise with non-Tier 1 customers cushioned the impact and helped sustain overall momentum. As shared last year, we have already undertaken capacity enhancements and developed alternate surfactant systems aligned to the new reformulations by some of our customers. Approvals are underway and we expect commercialization to start in Q4 FY26. With the normalization of GST-related adjustments, continued specialty strength and the planned commercialization of alternatives, we remain confident of a gradual improvement in our India growth trajectory. Coming to AMET, the market conditions remain challenging. During Q3 FY26, the region recorded a double-digit year-on-year decline in high teens, driven largely by market share losses in key Tier 1 accounts amid heightened competitive intensity, including pressure from backward integrated and local players. However, we have an update based on some recent developments. We have recovered significant volume traction in Q4 25-26 from most of our customers, which will get reflected in the upcoming quarter's performance. Our teams remain deeply engaged with customers, strengthening our value proposition and actively working to rebuild our position across both Tier 1 and non-Tier 1 segments in the region. Coming to the rest of the world, it performed well and helped balance the portfolio. On a year-on-year basis, rest of the world volumes grew mid-single digit, with Latin America and Europe posting growth and sustaining healthy demand across both performance and specialty segments. These gains partially offset the tariff-induced softness linked to the North America and specialty exports from India, and they underline our strategy of geographic diversification and disciplined market development. Tricade, our super specialty business segment, catering to high-end prestige products, delivered a strong performance, enhancing the EBITDA profile of the group. Coming to innovation, as per the strategy 2030 that we announced in Capital Market Day in June 25, we are pleased to inform that we have launched 5 new products in Galsop Sun Bliss range in sun care, Levon segment in November month at In Cosmetics Bangkok. These second generation molecules are designed to offer high photostability, strong efficacy at low dosage, broad spectrum UV protection, including blue light defense, and improved sensory performance while meeting evolving safety and environmental standards. We have received very favorable response in this regard, and these products will be commercialized from Q4 FY26 onwards. An update on our rebranding initiative, which most of you would have seen. In January 26, Galaxy refreshed its brand identity after 45 years as part of its ongoing strategic evolution. Guided by the purpose, chemistry creates care, the new brand identity reinforces the company's focus on long-term partnerships, responsible innovation, and sustainable value creation. Alongside this, Galaxy is expanding its portfolio beyond home and personal care into beauty, derma, and wellness segments. While the visual identity has evolved, Galaxy's core strengths, that is quality, reliability, and technical expertise, remain unchanged. The refreshed identity clearly positions Galaxy as a trusted, future-ready partner for customers and all external stakeholders. Coming to outlook, on the cost and supply side, we saw a few moving pieces. Freight offered some relief, but operational frictions like port congestion persisted. In raw materials, despite a brief softening of oleochemical inputs, the quarter's average price correction was not significant, and as we entered January, the fatty alcohol prices began to firm up again, consistent with seasonal patterns and festival-linked demand. While new fatty alcohol plants are coming up should improve availability, palm kernel oil remains a factor that we need to be looking at and planning with what we expect as the way the market would move forward. On demand side, India performance volumes are expected to increase incrementally in both Tier 1 and non-Tier 1 accounts, and we do see a double-digit volume growth on the specialty segment to continue. Amet recovery of volumes seems positive from Q4 onwards and be of high priority. For rest of the world, performance surfactants growth will continue to be driven by the momentum as was evident in Q3. And as regards the specialty segment, our existing customer growth pipeline projects are expected to get good push as regards our North America business, thanks to the tariff reduction, and will start reflecting from late Q4 and start of Q1 next year. In conclusion, I would like to say that we are confident that the worst is behind us. With the India growth story improving, Amet volumes gradually recovering, incremental profitability expected from the recent US-India tariff reduction announcement, and a sustained improvement in our premium specialty product mix, we are confident of regaining our growth momentum in the coming quarters. Thank you for your continued trust. I now open the floor to questions. Thank you.
Thank you so much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Our first question comes from the line of Sanjay Jain from ICICI Securities. Please go ahead.
Thanks for the opportunity. I got two sets of questions. First, on the regional performance. On the Amet, we said that there is a competitive intensity which has increased in Q3, but at the same breath, we said that Q4 we are looking at the volumes to come back. What has changed just in a matter of a quarter, which is giving us a confidence? And in Amet, we are already down 35% from our peak quarterly volumes. How much of that we can recover, say, in next one and a half year? That's on the Amet. On India, we were supposed to adopt the new changes in the formulation with new product introduction. Where are we in that process, and when should we see volume from that segment coming? And on the rest of the world, you sounded quite optimistic on US trade deal. And you did mention that you expect specialty volumes to grow at double digit. It is more like FY27, or you expect for next few years the specialty should grow in double digits? So this is on the demand question side of it. Thank you.
Yeah, on the AMET side, what has changed between Q3 and what will happen in Q4 is in terms of certain of the businesses that were in pipeline, and we are discussing with certain new geographies there. We have been able to complete that towards the end of last quarter. Because although the competitive intensity is there, we do have to keep rejigging in what pockets we need to be catering to within AMET. And I think that we did a good job towards in quarter 3, but we expect those volumes to start flowing in only from Q4. That is as far as AMET is concerned. With regard to
5% down from the peak, now where do you expect that to reach? Do you expect to reach that peak in next 1.5 year, or will it take more time?
No, we don't expect it to reach the peak, because we very clearly have told that we have had a new relative where you have a person who is backward integrated and who has also taken share from the Tier 1 customers there. With all that has happened over the last 2 years as far as the currency availability and the depreciation is concerned in the key market of Egypt. So that is something that will not come back.
Okay.
Yeah.
So, but we'll get back to the growth here mid.
Yeah. So what we are essentially doing is that we are trying to see with the new normal, how are we able to look at other markets in AMET, the way that we are able to balance it out with the credit risk. So that's what the team is working on, because we can't say that what has gone we will not recompensate. That's why the team is working. But to compensate within the existing scheme of things is not going to be possible. That's why it's taking time. But in next 1.5 years, if you ask me today, I don't see that we'll be able to come back to those peak volumes.
Very clear. On India?
On India, with regard to the new this thing as well, we are ready. But then what also happened was last our customers, the key customer who reformulated was very busy with battling the GST rationalization and inventory adjustments. So we are in the process. We expect the approval to happen anytime, and business should start anytime now. But the major impact of that will be felt only in the next year.
Got it. So we will be back, so double-digit growth in India with that product coming.
We should be, but we also had said last time in terms of reformulation, there have been also the active adjustments that have happened. Okay, so it all depends on what's going to be the way that they're going to look at in terms of continuing with that or trying to alter it further, so which we don't have any idea. But if the current situation continues, we need to see the growth momentum coming back. Because the double-digit growth can happen only if the market is growing. India market, even today, if you see, all of them are reporting 2 to 4% volume growth, underlying volume growth. So that really needs to come back. All our customers are saying that the GST rationalization should bring that up to that level, and they are working towards making that happen. But it has to get reflected in the actual numbers that they're going to be selling.
Got it. And on the US?
Yeah, on the US, obviously, so if you see, the tariff actually created an issue for us in terms of the way that we are running the customer projects there, where the customers were essentially very, very apprehensive in terms of whether they want to continue working on the projects in pipeline. Now, with the way that things have settled down, it is not only in terms of the tariff, but also the way that India and US have warmed up. So customers do feel that this would be a stable situation to move forward. And we are seeing that, based on the last 2 weeks of discussion that we had customers, there is a positive momentum in, restarting evaluation of various projects in pipeline that were suspended. So that gives us the confidence in terms of it's going to start, it's starting to show certain, uptick in demand for those products that got impacted due to tariff from end of this year, and more it will be seen in the next year.
So we should be growing for double-digit volume growth in specialty.
We should be seeing that. Yes. But then it's all a question of how we are. The customers are going, because it's also a situation where we do not know what contracts customers have done for the products already, when those contracts are expired, because everything went into a limbo. Now the team is, with all the customers, we are trying to understand that, but initial thing indicates that it looks positive. To what extent we are positive, we'll get to know probably in the next call. I'll be able to give more clarity.
Very clear. My second set of question, more like bookkeeping. Natarajan, you said that the margins were also boosted because of EPC segment. Can you give more detail on that? And the second question.
No, I can only tell you, Sanjay, that if you look at it on a YTD basis, it is not significant. Since it is with a single customer and with confidentiality arrangement with them, we are not able to reveal the actual number. But it is, I can say that it has not been significant.
Got it. And just one bookkeeping question on the. There is a significant jump in the other comprehensive income for last 2 quarters from a line item where we need to recognize it into P&L in a later date. What exactly is that?
No, those are basically coming from your exchange rate movements coming from subsidiary adjustments. So
why should it get recognized later in the P&L in that sense? I think that.
So those are these are the items which get only that can only come to P&L once you sell your investments in subsidiaries, or get back that money into subsidiary back to India. So these are all it's a foreign currency translation reserve sort of.
Okay. Got it. Yeah. That's it from my side. Thanks, Natarajan sir, for all those updates, and best of luck for coming quarters.
Thank you so much.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1. Our next question comes from the line of Arun Prasad from Avidis Park. Please go ahead.
Thank you for the opportunity. Good morning, Natarajan.
Good morning.
First question is on this tariff related to US. Have we shared any tariff with the customer during this intervening period? And if so, with this update on the trade, should we see some kind of gains coming back in terms of margins?
No, I didn't understand. When you say shared with customers means?
So a lot of companies have indicated their tariff burden is shared equally between.
That's what we said. So what we had done was that to respond to that, there are certain businesses that we could actually cater to from Egypt. We moved it to Egypt. What we couldn't move, we had to take either some of it, 50%, it didn't make any sense to do the business at all because you can't be cash negative. So we didn't do those businesses. In which products where we could absorb some portion of it, we took that call to keep the volumes going. So as we move forward, what we would see is that the major outlook for us, or the major outcome that will be good for us is where we are able to build the volumes, okay, in terms of all the products which we can only do from India, and that's what we're focusing on. Now, to the extent that we have taken some calls on some products where we took a margin call, to the extent that the duties have come down from 50 to 18, once my current contract gets over, we can start reinstating.
So you are confident that the rest of the world should grow in double digits? It's more backed by the return of the volumes from those geographies which we couldn't deliver because of the tariffs. Is that the right understanding?
See, right now, even without US, we are growing well in the rest of the world because we started pivoting to other locations like in the rest of the world. Okay. Now, that momentum we want to maintain. And we also want US now to come back, okay, after the customers start warming up with the new reality on tariff and the way that India and US are warming up. That is going to be a plus for us. But the product categories are very different. It's not that whatever volumes I couldn't place in US, we could place elsewhere in the rest of the world. Because there's also a mix that has changed. So all this will get reset the moment we move into the next year. Hello?
Okay, sir. Second, on this EPC revenue and earnings, will it be similar to what we are seeing in this year going forward also, where there are small amounts will be booked each quarter, or will we see some kind of a bulk or a major significant revenue and earnings to come in, say, FY2025?
It will be spread out because we are expected to be completing this by Q4 of next financial year. Okay, so it will get recognized in small pockets. Not that there will be anything that significant will come in one quarter. Okay.
Okay. Because when we initially announced, what I remember is there will be some significant amount which will come at one go. So that's not going to be the case in any quarter going forward.
It's a question of what we receive and what we recognize. Recognition happens based on the way the accounting standards mandate, correct? So we are recognizing income based on what the accounting standards mandate, and that will be evenly spread out, linked to the percentage of completion of the project, correct?
Right.
Yeah. That's
So,
what we do.
If this entire process is not giving us, say, a meaningful earnings even in any single year, what is the benefit that we are actually going to get? I understand we will be improving our relationship with the customer, and at some point of time that may result as a better volume. But what is the tangible benefits we are going to see in the medium term from this?
What we said. First is we are with our customer as part of their strategic intent to backward integrate. And that was not the only reason. It's also in terms of we getting access to volumes to for our performance surfactants in the biggest market for home and personal care, that is the US, North America. That is the prime move that we are doing. And it is not that it is not significant. Okay, it's not that it is something that is going to change, because it is not based on what EBITDA we have. It is not something significant from that context. But from this project as such, it will be. We need to understand the context in which we are saying this. Okay, and we are not doing this because we want to get into the business of EPC. No, we did this because it's going to give us a link to our strategic market of North America.
Have you already started getting some benefit because of this in terms of volumes or margins or a mix?
So now,
because at least we are not able to see this in the numbers.
So you can't see that because this is in the performance surfactant segment, and the project will be commissioned only in Q4 of next financial year. It is not a commission. Where will the volumes come?
Okay. Understood, sir. But anyway, those projects, that plant will be operated by the customer, right? We will not be reporting in our numbers.
No, we will not be. We will only report numbers which are in terms of what volumes we are going to be off-taking for our requirement in North America.
Okay. Understood. And one more question on the gross margin this quarter. If we see in the first half, on a per kg basis, we are clocking close to around 49 rupees per kg. And Q3, suddenly we are looking at 53 and off per kg. I'm looking at the reported EBITDA per kg translated into gross margin per kg. So this first half of 49 to Q3, 53 and off. Again, is it dramatic shift in the mix or pricing, so the lag effect? How should we look?
No, this, as I said in my opening remarks, one is our Tri-K, which is into prestige specialties, did very well. So that is one of the reasons. Okay. And the other one is also what we sell from India. Okay, there is a mixed impact. Okay, but as we said, our Tri-K business, which is into prestige specialties, had a role to play in terms of this being better than what it was in the first half.
Okay, but from last year's, say, FY20, cumulatively we had close to around 52.5 rupees per kg of gross margin. From there, the first half reduction to 48, 49, that was primarily driven by our mix. But again, from the...
I'll tell you, what happened was the major reason in first half was when the tariff was announced for US. Some of the businesses just got stalled. We had to also take time to be rejigging business from India into Egypt, whatever we can do. The mix also had to undergo a change because certain products we couldn't sell out of India. And then we had to be seeking other markets like in the rest of the world okay, where we have to place it in a sense of urgency. So it's not that we could get time to be able to get the pricing we want. So it was all about how do we rejig our portfolio in terms of our locations and geographies based on what the tariff situation presented. That's what explains that.
Right, sir. So this gross margin per kg
I'm
that we
sorry
have
to
shown
interrupt you,
Q3.
sir, but you may please rejoin the queue for more questions. Thank you.
All right.
Can I answer this? What I think last question that he had, so that we don't lose
Sir,
continuity.
this is a sustainable gross margin unless and until we see some kind of
I will have clarity because my US thing has to sustain, because I'm also seeing that the US market, based on all that my customers, like when one of our key customers who has a big presence in beauty and well-being in US has flagged concerns in terms of demand issues in US. So that means we need to see how Trike shapes up. But I don't see that as a big concern, the way that the Trike business is performing. But I need to make a clear statement only when I go into the next quarter, our call. The other thing is, with our tariff getting reducing, we also see that if all my customer projects that were put on hold and business that we actually are suspended, once that starts coming in, it will start to state the margin profile. So I would urge you to wait till May, when we will have our call for the full year. I can give better clarity.
Understood, sir. I'll just rejoin the queue and all the best
No
for
problem.
your...
Thank you, Arun.
Thank you. Our next question comes from the line of Archit Joshi from Nuvama Wealth Management Limited. Please go ahead.
Hi. Very good afternoon, sir. Thanks for the opportunity. I have a few. First one, we have been hearing from you about the reformulation strategies adopted by our customers. Sir, my question was whether have we seen this happen in the past? Is that like a permanent reset to a particular surfactant being used in a lower quantity, basis their cost structures, of course, and should that reverse sometime in the future? What have been our experiences when such a shift happens at the customer's side?
So I'll tell you, so it's not that it happened for the first time. It happened earlier, but then the tenure for it, the price delta between fatty alcohol and crude petroleum derivatives have been not this prolonged. Okay, so that's one change that has happened. Second is, any reformulation in terms of activity adjustments or your alternatives being used typically are something that is not our customers would do in the normal course. They're doing it because they're forced. So I can tell you that once price start getting corrected to some reasonable levels, okay, we would see that they would revert to what their original formulation was. So these are all temporary adjustments that they're making. Okay, and that's what even a dialogue with the customers tells us. But we are hopeful that the fatty alcohol prices should start getting corrected, say, from May onwards, because we do see that, structurally with the high season months coming in of palm and palm kernel, okay, it should start reflecting. But yes, we don't have a crystal ball in front of us, but this is what is expectation based on what we have seen in the earlier years. So we need to wait for that.
Understood. Sir, if I understand correctly, long story short is that there is a chance that the actives used in any formulation can go back to the same levels that earlier they used to use. Yeah, of course, timelines notwithstanding.
Yeah. When it will happen, it's all a lot of imponderables around that, but yes.
Got it. Sir, secondly, I remember, speaking to you on the mix that we have amongst our customers, and we are definitely seeing some shift of, some local niche kind of players who have gone up in the total salience of our total revenue mix. So in this quarter, as I can see from the presentation, 40 is going to 47, and on a 9-month basis also we have jumped from 39 to 44. How should we read this, sir? Is it that because of these reformulation things, the MNC customers have dropped significantly in volume, and because of this there's an optically higher number seen in the mix of these local and niche players, or we have actually seen local niche players grow significantly in volumes?
For its percentage, obviously, you also know that the denominator has an impact. So if the denominator comes down, the percentage goes up. But that's one part of the explanation. But more importantly, which we have been constantly saying, is that we are very deeply entrenched, okay, and a huge amount of engagement with all our Tier 2, Tier 3 and D2C customers, which is what enables us to ensure that we were able to mitigate a good portion of the impact because of the reformulation by a Tier 1 customer with what we could do with the Tier 2, Tier 3 and the direct-to-consumer brands. Okay, and that particular intensity to grow that segment is not something that we are doing now. It has been a stated strategic agenda for us, and we'll continue to maintain and build on that momentum. That we are very clear, and we also know that the way the markets are looking at it, you'll have D2C brands are here to stay. It's all important as to how we have a business model that enables to address it very effectively and sustain whatever growth that we achieve with the business with them.
Understood. So, would that be fair to assume, sir, there will be a gradual pivot towards these local niche regional kind of players, and that should any number as a percentage of mix that you would be targeting over there?
See, one thing that I say percentage derivative, it is not that we are deliberately pivoting towards Tier 2, Tier 3 and deprioritizing Tier 1. Though that is not the way that we will do business. If the churn happens in the end market, we are well ready because the way that we engage with all tiers of customers. Okay, that's the way it has to be understood. Our strategy is not to deprioritize. Okay, we'll have to have the ability to serve all the segments and in a way that they would want it, the way that the market configuration happens. And that's what we've been doing for the last 40 years. We'll continue to do the same thing.
Got it, sir. One last small one on this extremely welcome development with regards to commercialization of 5 new products under the D1 category. Hearty congratulations on that. And since we are hoping to ramp up production, sales, and commercialization from next quarter onwards, would you, sir, like to give us some more understanding with regards to its potential from an export perspective, or whether it will be domestic, or any particular customers? Would there be MNC or regional players? Anything on that account that would be helpful. Thank you.
Yeah, so it will be essentially, we launched it in November. We are able to see a good amount of response, and that is very heartening. It will be in India and out of India both, because it is in the Levon segment, it is in sun care. Okay, and obviously we don't have any specific focus on we'd say that it's not that we want to focus only on Tier 1 or Tier 2, Tier 3 customers. This is a product we have got interest across all tiers of customers, and our objective is to see how we are able to progress well and convert all these positive inquiries into business. That's what we are working on.
Understood, sir. Sir, this would have a significantly higher EBITDA per ton, right, compared to our existing or blended number that we are reporting, close to 18,000-20,000 tons.
Yes, it should have. It should. Correct.
Understood. Understood, sir. Thank you, sir. Thanks a lot, and all the very best.
Thank you so much.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address all the questions from the participant, we request you to kindly limit your question to 2 questions per participant. If you have a follow-up question, please rejoin the queue. Our next question comes from the line of Aditya Khetan from SMIFS Institutional Equities. Please go ahead.
Yeah, thank you, sir, for the opportunity. Just a couple of questions. Sir, when we say, so we are pivoting to other regions for growth in export market. So compared to US market, also whatever benefits which we had got in US, are the other markets similar in terms of the remunerative prices, or they are below, or they are higher? So whatever markets like we have explored during this tariff journey, how you see that journey to build upon, or so US will come back to normal?
See, first of all, it's not that in the rest of the world on our specialties we are focusing on all the markets, North America, Latin and Europe. But then when the tariff situation presented to us in Europe, then we had to be looking at how do I start seeking more business from those segments, and obviously we had to even do certain things which were, because what option we had, either to take those huge margin hit in terms of continuing to sell that into the US, or look at other markets where the impact can be lesser than what margin impact we will have in the US with the tariffs incorporated. So that will ensure that there is no question of saying that whether I plan to have what margin I need. Now, whole thing was to ensure that we start pivoting, because we never knew how long this US situation will continue. Correct? Now this positive development has happened in terms of the tariffs getting reset, and we don't have any comparable disadvantage vis-a-vis others in the world. Almost everyone is at 18-19%. Okay, so this gives us the confidence to restart, okay, the strategic pipeline projects we had with the customers in US, which was what was originally intended. Okay, so we'll then start, once those things start fructifying, we start rejigging back into the US, those volumes.
Got it. And for this customer which you have mentioned, US customer has stated like demand is an issue. So how you see the uptick would be gradual, or it would be very easy for us to take back the lost volumes and market?
The first time, if you see for the first time, two of the biggest guys, one of them is the biggest in the US, the other one is very big as far as your personal and home, your beauty and well-being is concerned. Therefore, the first time flagged concerns with regard to the demand side in the US. We haven't heard this till now. When we see the commentary of some of our competitors in the US and Europe, they are all pointing towards a huge concern, okay, on the robustness of demand. The first time when the customers are flagging this, okay, is when we say fine. If they're saying that they're probably much nearer to the consumer side of the business, so we said let us take this input and keep it into our mind. Okay, that's what I communicated. So when someone asks whether we expect the US business to be continuing into double-digit growth, I said this aspect has to be factored in. Although if everything continues as normal, these things would be much better, given that the tariff situation also has got resolved in a very positive way.
Got it. So, sir, despite this slowing, suppose if that issue persists on the demand side, we still sir, maintain our volume guidance of whatever for the next 2 years. Is that maintained, or would be again some cut?
See, volume guidance, we talked always about 6 to 8%. Okay, so see, it's actually very dangerous to change guidance when things are in such a state of flux. That's the reason why I'm not courageous enough to do that, because I don't want to be, revising the guidance has to give more clarity. It's not confused, correct? That's the reason I'm not doing it. Now, there are too many things that are happening on the positive side in the geopolitical situation. If all that falls in place, okay, we do see, okay, that things should start looking up and take us closer to that 6 to 8%. Because what is very commendable as far as the performance is concerned is that despite so many challenges in India, which has been the biggest market for us, with the tariff in US and with what is happening in Europe, okay, we've been able to, have a positive volume growth, okay, and also able to keep our profit numbers flattish, okay, by combination of how we rejig our demand and also in terms of how we took care of costs. So this essentially again is a very clear demonstration of the very, very robust business model that we have across customer types and across geographies and across product segments. Yeah.
Just one last question, sir, if I may. Sir, into the EPC business, any sort of an guidance for the next 1 year or for the next 2 years, how much contribution we can see from this business, and how much EBITDA diversification will happen from base business to this? Any sort of a number considering next 2 to 5 years view?
So first of all, I just said, if I can give for next 2 years, I would have given as to what we have recognized in this year. That's why I said it is not significant. And then I was asked if it's not significant, why did I do it, which also explained. Okay, so I can only tell you that in the coming years also it will be there, but it will not be significant in terms of what we are doing with this customer. Since I am bound by confidentiality agreement with this customer, I am not able to disclose. Otherwise, you know that as an organization, we are very transparent. Okay, we would have disclosed.
Got it. Thank you, sir. That's it from my side.
Thank you. Our next question comes from the line of Dhruv Muchal from HDFC AMC. Please go ahead.
Yes, sir. Thank you so much. Sir, first question is it possible to share how much portion of your India business is getting influenced by this reformulation? And to some degree, is it already, I mean, is it there in the Q3 numbers, or more can happen?
No, as of today, whatever has happened is fully reflected in my Q3 numbers. Okay, and if you look at the entire degrowth that has happened in India, if you compare it with last year to now, which we have been able to mitigate with some good business growth that we had with our Tier 2, Tier 3 customers, has entirely been due to this reformulation. So, if we don't see the base getting altered significantly if the current situation continues, but if the if you have the fatty alcohol prices and crude petroleum prices further diverging, okay, then we cannot make any statement on, because then we need to go back to our customers. But as of now, what has happened has happened. Okay, so we don't see that increasing further.
Sure. So I'm asking why, because there would be some products where the formulation can never happen. I'm assuming there could be some products where the reformulation can never happen. So, from that angle, I was trying to understand.
Yeah, correct. So whatever, I think most of what could have happened have happened. So customers also are they do give us advance information, but they will not tell us into every detail that they are planning. But based on whatever discussions we have had with their top leadership, I think most of what they had to do, they have done.
Got it. Sure. And so secondly, that we are seeing this reformulation strategy of yours will start to play out from Q4 and gradually from Q4, and also the AMET growth will start to see. I mean, at least the base is there now. We'll start to see volume growth back. But just trying to understand how is this business from a profitability perspective, both India and the new growth that we are seeing in AMET. I mean, is it meaningfully different than what you were historically doing? And initially there will be some learning curve and some market share gain related push, which will influence the margins or the EBITDAs versus what you typically used to do historically, or they are broadly similar as what was earlier?
Yeah, so the first objective we have is to be meaningfully present into certain reformulations that have already happened to the extent that we need to. That is the first objective. So once we get there, we also know that because the pricing is what there is in the market. It's not a new product. Okay, it's something that is already existing, and then we obviously didn't get into that because it is a petrochemical-based feedstock. So we said, let us first prepare ourselves to participate in this reformulation. Similarly, in AMET and those new countries that we're looking at, okay, we are very clear that we will not get into any country where we have significant credit risk, but we are also looking at taking appropriate margin calls to get the volumes. Because first objective is to get the volume traction back. Okay, but it is not that we are taking calls that are going to be injuring us in terms of margins. But yes, these actions that we are taking are not going to be super margins that we will make. Okay, so it's going to be something very normal.
Sure. And so last question, a quick one, is when I do a console minus standalone, I see the subsidiaries, which effectively I believe is Egypt and the US and some other businesses, seems to be doing well. And this is despite AMET, not doing as well for the last few quarters and probably few years. So is it primarily driven, and particularly this quarter seems to be strong. So is it primarily because of the US, because of the Trike, or there are other factors, probably mix in AMET is improving and all those? Is just trying to understand.
No, I think the major here, if I can say, is that your US, I said, in terms of is a bit better. But the major impact in terms of standalone being low is because I said India has been significantly impacted due to the reformulation.
Yeah. So standalone low is understood, but the gap seems to be okay. I mean, that would mean the subsidiaries are doing well.
I think is also majorly what I said in terms of what is happening in our Trike business, where it is able to give us some good growth in terms of profitable growth, which is able to compensate.
Okay, got it. Sure. Great, sir. Thank you so much and all the best. Thank you.
Thank you so much. All the best. Yeah.
Thank you. The next question comes from the line of Umang Shah from Banyan Trees Advisors. Please go ahead.
Hi, sir. Thank you for the opportunity. Sir, just had a question on AMET. You said that, I mean, you mentioned in the press release that there was a lot of local competition. Is this cost-based competition, and do you think it is sustainable?
So see, this competition is not coming now. In fact, it has happened when Sanjesh also said the peak volumes that we had was all when Egypt was in a very steady state. Currency was ruling at something like 15, 16 to a dollar. Today it is at 45. Okay, and inflation, they have passed through some 100% inflation. Today they are at 40%. So now, with all this, what has happened is that there have been some local players who have taken advantage of the situation and have come up with product formats and pricing that have been significantly cheaper. Okay, and they're also backward integrated. That's what resulted. Okay, in now, because when my customers there, my tier 1 customers lose share, it certainly reflects on us, and there is no way that I can gain back that share with others who are now taken in end market share because they are backward integrated. So that is something that is not something that has happened now. That has happened over the last 3 years.
Got it. Got it. Very useful, sir. Sir, and the second question is, after a long time, there has been a decline in raw material prices, fatty alcohol prices on a quarter-on-quarter basis. Do you see the price increases impacting or benefiting the EBITDA per ton?
No. Actually, whenever prices decreases, it decreases briefly, but then we were also very cautious because when prices start decreasing now, when alcohol was at $3,000 and it went to $2,500, $2,600, typically the problem is the risk we have to manage is a very high intensity because customers then expect it to come down further, don't do deals. But we need to buy to continue our production. So we are very, very conscious now how to manage the risk. Now, after all of them were waiting that then they will do their deals once it comes down further, now it has started going up. So now customers again are coming to buy, okay, but again are doing deals which are short term because they say it has gone up, it will come down. So this aspect of it is not a question. If it has been secular into a particular rising situation or a fall, I think it's very easy to manage the business. If it is a situation where it keeps fluctuating very frequently, the frequency is what is a problem today. And the issue reflects in terms of the way customers are looking at doing deals because they're being very short term. You know, they're looking at deals for doing 1 month, 2 months, and 3 months. Okay, that means your risk profile increases because you have to manage the raw material risk in that frequent way in which customers are doing the deals.
Got it. Sir, but I assume that we had an automatic quarterly price increase that you are passing on to the customers in performance segment.
So that is for our contractual customers, but I think we have a good business happening with our non-contractual customers. No, that is tier 2, tier 3. I'm talking about that. Yeah.
Got it. So the tier 2, tier 3, they don't have any price increases. It's basically the negotiation not on a quarterly basis.
Correct.
And how frequent would that be?
Quarterly, some of it is monthly, some of them do 6-month deal, depending on how they see the raw material situation. So one is what we give them information as far as what we know, other is what they know. And finally, a decision happens. So some of them do a 6-month deal. Even today, we have people who are doing a 6-month deal because they expect prices to stay firm. There are some people who are going short. They're only doing it for 2 months. So it's a combination.
Got it. Thank you so much, sir.
Thank you.
Thank you. Next question comes from the line of Divyansh Gupta from Latent PMS. Please go ahead.
Hi, sir. Am I audible?
Yes, you are.
Yeah. So regarding the alternate formulation that we have developed, some questions regarding that. So is my assumption correct that this is not a supply constrained situation, as in the tier 1 customer or other customers would have enough decent supply of players providing them with the reformulation. And therefore the question is that given that we have developed a technical formulation to serve the customer, what is going to be our edge to grab any market share? As you also mentioned that majority of reformulation has already happened.
So there is no question of grabbing market share. It is that we lost volumes to the reformulation. My customers, obviously, they reform it because there's someone else who was making that supply. And the reason why we are confident that we'll be able to get a good portion of the volumes back is in terms of the strategic arrangement we have with the customer, and the volumes that went out from us would come back once we are ready with that particular alternate feedstock, alternate, formulation. That's it. There's nothing of we trying to grab market share.
I just replace whoever they were buying from.
Yeah, correct.
Got it. Understood. And the EBITDA realization for this would be lower than our performance surfactants or largely similar?
Should be largely similar.
Got it. Understood. And just last question. With the UK FTA and the EU FTA, does it benefit us in any which way with respect to pure cost competency?
No, so I don't know, with UK, there is nothing much that happens in UK, the business. So it's not that the duties were very high. Okay, but UK as a market, most of it used to get done in the other parts of Europe and getting into UK. So our team is now working with some customers in UK. So the UK FTA is not something that's going to be of any great significance to us. But the EU FTA, yes, because what is important is that even earlier you had, again GSP, your general system of preferences, you used to have duties of 4 to 6%. Now that is going to go to zero. That it's not that the duty rates are very high.
Got it. So it's not going to make us marginally any more competitive. Large competition edge is not there.
Yeah.
Got it. Understood. That's all. Thank you and all the best.
Thank you. Our next question comes from the line of Rohit Nagaraj from 360 ONE Capital. Please go ahead.
Thanks for the opportunity. The first question is on the palm kernel oil prices, fatty alcohol prices. Given that in the last 1.5 years, the prices have been hovering more than, say, $2,000 per ton, is it a structural shift that has happened where earlier the prices used to be about, say, $1,500 plus minus dollars per ton and now moved consistently at $2,000 per ton?
No, I think whether it's the structural shift, we'll have to wait at least for the next 6 months to understand, because it has run through a cycle of close to 15 months. So we need to see it at least up to next October. Okay, and then because there have been too many amount of external stimuli that is causing prices to respond. Okay, so now with all that is happening in terms of the geopolitical situation, crude petroleum prices, because one thing we see is that when the crude petroleum prices correct significantly, okay, there can be an implication for the farm value chain, because we have always seen a positive correlation between crude petroleum prices and palm oil prices. Okay, so that is something that we need to keep a watch on. Okay, we need to also keep a watch on in terms of the production numbers. Our initial, discussions with the marketplace tells us that this year they expect the production to be good. With the recent palm oil conference where my colleagues attended, I think it is pointing towards a good production scenario in this year, which can also be bearish for the market. But how much bearish, we don't know. And whether if there is any other external stimuli that's negative, it can keep the prices high. But the way I look at it is that the probability of prices going up further from here is low as compared to prices coming down. To what extent they'll come down, we'll have to probably wait till May, June.
Sure, got that. And second question, in terms of the beauty and personal care, we have been more and more focused now on the leave-on category than the rinse-off. Just wanted to get a perspective, maybe 5 years back, where were we in terms of the proportion of rinse-off and leave-on, and where are we now? Because I think last year when we had incorporated the 2030 vision, we had categorically stated that this is the area which is going to be the area of growth for us over the next 5 years. So just to get a perspective, I mean, the numbers...
If you look at it, the entire HPC market, okay, traditionally and for the years to come, it will always be very highly skewed towards rinse-off applications. Because I think cleaning is what is the biggest part of the home and personal care market. You see it's fabric cleaning, or it's your surface cleaning, or it is your dish cleaning, or it is your institutional cleaning. So that will always be the case. So essentially our focus is going to be continuing to be very intense on the rinse-off segment. What we're doing is, We are adding an additional listing on the Livon segment, which is more focused on what we call as the beauty segment, okay, which is more to skin creams, skin lotions and all that, coming up with ingredients for that. Okay. So that is why moving. So essentially, it's not that even moving forward, in terms of volumes, they can be significantly as a higher percentage. But we need to be very choosy about which product categories we want to get into as far as Livon is concerned. That's why we see we launched what we call as the sun care ingredients, Gal Got Bliss, that we launched in cosmetics in November. So we'll be very particular as to what sort of ingredients that we get into, because it has to be ensuring that we are able to sustain, the growth and the profitability.
Sure. Got that. Thanks a lot and all the best, sir.
Thank you.
Thank you.
Ruchi?
Our next question comes from the line of Aditya Khetan from SMIFS Institutional Equities. Please go ahead.
Yeah, thank you, sir, for the follow-up. So my question was onto the fatty alcohol prices. Sir, considering the inventory, what would be the inventory position today of RM, considering at $2,800 per ton versus $1,500 per ton prices? Is the inventory cycle shortened, and by how much days, if you can quantify that? And secondly, sir, adding on to that, so hypothetically, assuming if RM prices decline by 20%, just hypothetically assuming it, how much hit to EBITDA we can attribute it to? And also, sir, third onto this, if you can also quantify the differential between fatty alcohol and the crude petroleum prices, like what is it today and roughly 1 year back?
So you're actually a lot of questions that I asked my sourcing head, okay, in terms of how he's planning. So I can't be answering in this detail, but I can tell you that we have a very robust risk management framework in place which ensures that even if the prices fall significantly, if they rise, there is no risk. If they fall significantly, okay, our hit to the P&L will be minimal. That is how we have structured our risk management framework. That is one. The second is in terms of crude petroleum to this, I don't think as of now I have any specific response to give you. These are all some data points that we need to get into, so I don't have it readily available to respond on that.
Okay, and so just the trend like current, because for the last 1-2 months crude prices have went up. Most of the crude related derivative, whether LABSA, that is to make surfactants, that might have also moved up. So differential ideally would have been shortened. Any trend, if you can also highlight the trend is shortening and that would benefit more towards fatty alcohol players. Any sense onto that?
No, I don't think I'm able to see any trend. The lab prices going up is all related to some shutdowns that are happening now. And lab entire complex is very differently structured. So there are more details. I don't think I'll be able to explain that in detail. Okay, I think my sourcing head can have a conversation with you, okay, in more detail. Okay, but right now, I don't see any trends that we can relate to. Okay, they're all more short term in what is happening in lab, and what is happening in fatty alcohol is something that is there at least for the last 15 months. We need to wait till October to understand whether structurally something has changed.
Inventory cycle of RM, sir, if you can at least quantify that, how much would it be?
The inventory cycle is a derivative of how we want to manage risk. So there is nothing specific like I'll only run with 15 days inventory or 3 months inventory. We need to be having inventory to the level that we can continue our production uninterrupted, at the same time not have significant impact on the P&L in case the prices correct all of a sudden and significantly. So that is one of the differentiating the way we manage our performance surfactants business. Okay, and so it is suffice to say that we will not have any significant impact to our P&L even if the prices correct significantly. It starts coming down. We manage our risk very, very prudently.
Got it, sir. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would like to hand the conference over to the management for the closing comments. Thank you, and over to you, team.
Thank you, ladies and gentlemen, and thank you for the huge interest that you have in terms of understanding our business and our performance. I look forward to seeing all of you and answering all your questions and giving an update on the full year performance 3 months from now. Thank you and all the best.
Thank you.
Thank you, sir. Ladies and gentlemen, on behalf of Galaxy Surfactants Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.